Now that we know the definition for revenues and expenses, let me start by giving you a list of accounts that can be considered expenses: rent, telephone and internet, stationery, salaries, advertising, motor expenses, wages, insurance, and postage account. Notice how we create an expense account for motor expenses. So in the future, when you purchase a motor van, for example, you want to separate the purchase of that motor van and the expenses. So you have two accounts. One is for the actual asset, the other one is for the expenses. I will address that in another class. This list can be bigger, of course, but these are just a few examples of accounts that are expenses. Expenses. So do we debit or do we credit expenses? All expense accounts are debited. All. Why? To understand why we debit all expense accounts, we need to go back to the double entry rule that states that every transaction must have two effects: a debit entry and a credit entry. For example, cash paid for rent expense. In this particular case, cash, which is considered an asset account, will decrease. Hence, we need to do a credit entry. By default, rent, which is considered an expense account, will increase, and we need to do a debit entry. Keep in mind, again, every single transaction must have a debit and a credit entry. Each expense account has its own T account. At no point should you open a T account with the name expenses. You want to separate all these accounts to make it easier for you to identify things such as expenses for, let's say, for the past 2 years. It would be easier for you to get a figure if you have a separate account for rent compared if you have an account whereby you have rent, you have telephone, you have stationaries and salaries all included. That would be more difficult for you to get a figure of rent, but if you separate them, it's easier for you to get those figures. Posting expenses. So now that we know what to debit, what to credit, let us practice. So 2017 June 1st paid postage stamps by cash. In this particular case, cash is decreasing and we are paying for an expense by the name of postage. So our entry on T accounts should look like this: credit cash, debit postage. The second example, June 2nd, paid for advertising by check, 590. Our money at the bank is decreasing, credit, and we are paying for advertising, so we debit that particular expense. June 3rd, paid wages in cash, 1,960. The expense account is wages, so we debit wages and we credit cash. June 4th, paid insurance by check, $420. Our bank account is decreasing, so we need to credit the bank and debit the expense. So this is a summary of how the 4 transactions I just showed you should look like. Revenue. A few examples of revenue include rent receivable, commission received, and bank interest. Of course, you want to keep revenue accounts separate if in case you have more than one source of revenue for a particular business. So do we debit or do we credit revenue? Revenue accounts are credited. Why? We go back to the double entry rule. Every transaction must have two effects, a debit and a credit entry. For example, on June 5th, 2017, it is decided that part of a firm's premises are not needed at the moment. The firm lets someone else use the surplus space and receives rent of $740 by check. Basically here, we are getting a check of $740 for renting some of the office space or a building. So what is the effect of this particular transaction? So if we are receiving a check, that means that our bank will increase. Keep in mind that bank is considered an asset account, and the only way that you can increase the bank is by doing a debit entry. So by default, the other account has to be a credit entry. In this case, it will be rent receivable, and it's in this case that particular account is considered revenue and it is increasing. So we show that by doing a credit entry. This is how the entry would look like on your T account or ledger.